1. Revenue. This is where everything begins. The total money a business earns from selling stuff. Think of Apple selling iPhones. Every iPhone they sell adds to revenue. If they sell $1 million worth of phones, that's $1 million in revenue. 2. Expenses. These are the costs a company pays to keep things running. Rent, salaries, electricity, marketing. All of these are expenses. So if your cafe earns $10,000 but spends $7,000 on coffee beans and salaries, that $7,000 is your expense. 3. Profit. After you pay all expenses, what's left in your pocket is to be known as profit. For example, if your revenue equals $10,000, expenses equals $7,000, so your profit equals $3,000. That $3,000 is what makes business worth it. 4. Loss. When your expenses eat up more than your revenue. For example, if you earn $8,000 but spend $10,000, boom, you've got a $2,000 loss. 5. Assets. Anything valuable the business owns like cash, equipment, land, patents, etc. So if you run a bakery, your oven, shop, and cash register are assets. 6. Liabilities. These are the obligations, money the business owes others, like bank loans, supplier bills, or bonds issued. If you borrowed $50,000 to buy that bakery oven, that's your liability. 7. Equity. The part of the business that belongs to the owners after paying off debts. And the formula is assets minus liabilities equals equity. With example, if your business owns $200,000 worth of stuff and owes $150,000, so your equity equals $50,000. 8. Balance sheet. This is like a selfie of your company's financial position on a particular day. It shows what you own, assets, what you owe, liabilities, and what's left for owners, equity. 9. Income statement. This one tells the story of how much you earned, spent, and kept over a period, say a year. Like your 2024 annual report card. Did I make money or lose it this year? 10. Cash flow statement. Shows how cash moves in and out. You might look profitable on paper but be broke in cash. This statement reveals that truth. 11. Cash flow. Simply the money coming in and going out. For example, of customer payments are your cash inflow and paying rent is your cash outflow. So you can have profits but still bad cash flow if customers don't pay on time. 12. Operating cash flow. The real cash from day to day business operations if there is no loans or investments here. For example, the cash you get from selling 100 cakes this week could be used as your operating cash flow. 13. Free cash flow. Cash that's free to use after paying all expenses and buying new equipment. So if you earned $100,000 and spent $60,000 on operations and $20,000 on machines, so left over $20,000 is your free cash flow. That's what you can use to pay dividends or expand your business. 14. EBIT. It is earnings before interest and taxes. Basically, your operating profit before paying interest and taxes. So think of it as, how much did I earn just from running my business? 15. EBITDA. Like EBIT. But we also ignore non-cash costs, depreciation, amortization. And it shows pure operational performance, as if your machines never aged. 16. Gross profit. What's left after subtracting only the cost of goods sold. Example, if your t-shirt business earns $10,000 and making them costs $6,000, so your gross profit equals $4,000. 17. Operating profit. The profit after all business-related expenses are paid, but before paying taxes and loans, so this amount is known to be your operating profit. 18. Net profit margin. Tells you how much profit you keep per dollar of sales. If you earn $1,000, spend $900, and keep $100, so is your margin equals 10%. And remember, higher margin equals more efficient business. 19. ROI. Return on investment is how much you earn compared to what you invested. For example, you put $1,000 in ads and get $1,300 back, so your ROI equals 30%. And do you know that every smart business lives by this number? 20. ROE. Return on equity basically shows how efficiently a company uses shareholder money. If investors put in $100,000 and company earns $20,000, so the return on equity equals 20%. 21. ROA. Return on assets measures how efficiently assets generate profit. So basically, you own $500,000 worth of assets and earn $50,000 return on assets, which equals 10%. 22. Working capital. Money used for daily operations is known to be your working capital. Like current assets are $150,000 and current liabilities $100,000. So your working capital would be $50,000. And also that's your short-term breathing space. 23. Current assets. Stuff that turns into cash within a year is known current assets, like cash, inventory, unpaid bills from customers which are receivables. 24. Current liabilities. Bills or debts that you must pay within a year are your current liabilities, like supplier payments, salaries, short-term loans. 25. Current ratio. Tells if you can pay your short-term debts or not. The formula is like current assets divided by current liabilities. So if you have $200,000 assets and $100,000 liabilities, then the ratio equals 2. And that is a good sign. 26. Quick ratio. A stricter liquidity. Check which removes inventory. And since it's not always quick to sell, formula is current assets minus inventory divided by current liabilities. And if it's above 1, you're in safe zone. 27. Leverage. When borrowing money to grow your business is known to be leverage. So if you invest $100,000 of your own and borrow $200,000, so now you control $300,000. And more leverage equals more risk and reward. 28. Debt to equity ratio. This shows how much of your financing is debt versus owner's money. So $600,000 debt slash $400,000 equity equals 1.5, which would be considered moderately leveraged. 29. Interest expense. The cost of borrowing money. For example, you take a $10,000 loan at 10% interest, so it would be $1,000 interest expense per year. 30. Cost of capital. The minimum return you need to make your investors happy is your cost of capital. So if they expect 10% return, any project earning below that would destroys value and won't make the investors happy. 31. Weighted average cost of capital. It's just average cost of all the money you've raised, which is all the debt plus equity. So if your debt costs 8% and equity 12%, and you're 50-50 financed, weighted average cost of capital is almost equal to 10%, which is also known as WACC. 32. Capital asset pricing model. A fancy formula investors use to decide if a stock is worth the risk. So if return equals risk-free rate plus beta times market return minus risk-free rate. Yeah, that's an absolutely fancy thing. 33. Beta. So it measures volatility and how wild your stock moves compared to the market. So if your beta equals 1.2 and your stock swings 20% more than market, so it would be considered risky, but maybe more rewarding. 34. Market capitalization. The total market value of a company is the market capitalization. So it's calculated like the share price times number of shares. If each share is $50 and there are 2M shares, so it would be $100 million market cap. 35. Earnings per share is simple words at just about how much profit each share earns. So if total profit equals $1 million and you have 500K shares, then the EPS equals $2. And investors love rising EPS. 36. P/E ratio, price to earnings, tells how much investors are willing to pay per $1 of earnings. Like if stock price equals $100, so the EPS equals $10 and would be P equals 10. Higher price to earnings often means investors expect growth. 37. Dividend. A part of a company's profits that is paid to the people who own shares of the company. For example, you own 100 shares and company pays $2 dividend per share, so you can earn $200. 38. Dividend yield. Tells how much you earn from dividends relative to stock price. So $2 dividend divided by $100 share price equals 2% yield. 39. Retained earnings. Profits the company keeps to reinvest instead of paying out is known as retained earnings. So if you earn $1 million and pay $400,000 in dividends, so $600,000 would be retained for next year's growth. 40. Liquidity. How easily something turns into cash. Basically, cash equals 100% liquid. Inventory or property are not so quick in liquidity. 41. Solvency. Can the company survive long-term? Basically, if assets are greater than liabilities, so it is solvent. It may not survive for long term. And if debts are piling up and assets are less, it's considered in trouble. 42. Book value. The accounting value of the company, which is assets minus liabilities. So if assets are $10 million and debts is $7 million, so the book value equals $3 million. 43. Market value. What the market says about your company. Is it worth it or not? And it is often different from book value. Best example is that Tesla's market value is way higher than its book value because of investor optimism. 44. Enterprise value. The true value includes debt and cash. Formula: EV equals market cap plus debt minus cash. It's what someone would pay to buy the whole company. 45. Capital expenditure. Money spent to buy or upgrade big assets. So buying new machinery or expanding your factory is your CapEx. 46. Operating expenditure, OpEx. The costs of running the business daily, like salaries, electricity, maintenance, the usual monthly outflows. 47. Budgeting. Planning your income and expenses for future periods is known to be budgeting. 48. Break-even point. When total revenue equals total cost, so in the condition of no profit, no loss. For example, you sell burgers for $5 and it costs you $3 each to make, and you spent $2,000 on setup, so you need to sell 1,000 burgers just to break even. 49. Profit margin. How much profit you make on each dollar of sales. So if you sell a $100 product and make $20 profit, so you have 20% margin. And remember, high margins equals strong business model. 50. Agency theory. This one's more philosophical. It's about conflicts between owners and managers. So the shareholders want long-term value and managers might chase short-term bonuses. So the corporate governance tries to fix that. Part 2 will be coming soon, in which we would cover intermediate level of finance terms, so stay tuned for that. And I hope you liked the video, so please like, share, and subscribe.